First, JPMorgan's earnings were lacking in several areas. The bank beat slightly on revenues, but came up short on profits versus analyst estimates. Zoom into the results, and you will see weak investment banking figures and a cautionary view on the economy as culprits for the less than inspiring quarter. Yahoo Finance's Brian Cheung is leading JPM's earnings day for us here at Yahoo Finance. Brian, some of your top takeaways here.
Guys, it is officially earnings season. Get amped. First quarter 2022 results coming in for the nation's largest bank, that is JPMorgan Chase. Of course, never a dull moment when you have CEO Jamie Dimon, who's beginning his remarks in the earnings call, which kicked off about a half hour ago. But let's unpack the numbers themselves. When you take a look at the top line figure, beating the street's estimates, clocking in at $31.6 billion raked in for the quarter. They actually missed on the bottom line, 2.63 in terms of adjusted diluted earnings per share compared to the street's estimates of about 9 cents higher. They were hoping for $2.72. And the big reason for all of this is because of changes in their provisions for credit losses that they had in this quarter. Keep in mind, this is something that the large banks do to set aside any sort of possible losses that could be coming from the lack of interest payments if the consumer or businesses aren't able to pay back their loans. So actually, it increased by about $1.5 billion quarter over quarter. Compare that to last quarter's reserve release of about $1.3 billion. So one kind of interpretation of all of this is that JPMorgan Chase is getting a little bit more concerned than it was last quarter about the ability of the economy to sustain any sort of large leverage that they've built up during this recovery. And they said that's a big reason for the 23-cent decrease that they've seen in their earnings per share. That's because of the net credit reserve build. One other point that's worth mentioning here is that JPMorgan Chase did see a kind of tepid loan growth when you look at the consumer themselves. So it's not like people are necessarily taking out that much more in terms of credit cards or mortgages, for example, but corporate and investment banking revenues certainly keeping their overall numbers afloat at $13.5 billion. But when you take a look at the pre-market trading of JPMorgan Chase stock, certainly down. That is underscoring the concern that analysts have over the health of the American economy, especially with inflation running as rampant as it is right now.
And Brian Cheung, as we take a look here at the business units and their relative performance, of course, as you pointed out, investment banking was weaker than expected, whereas we did see fixed income and equities sales and trading revenue come in better than anticipated, albeit while still being down on a year-over-year basis. What do you think this suggests about what we should be expecting from some of the other big banks reporting this week?
Well, this is certainly suggesting to me that this is the turning point that we're starting to see for the banks. The big story during the depths of the crisis was that these banks, in the absence of any activity effectively from households and businesses, they were relying on trading through a volatile market on the equities desk, on the fixed income desk, trying to do underwriting for IPOs and SPACs to make ends meet. But the story over, I would say, the last 4 or 5 quarters or so was going back to that bread and butter business, growing your loan pipeline, being able to make some alpha even at near zero interest rates to effectively make money off of that interest. And that's because the net interest income, net interest margin was increasing over those few quarters. Even though the Fed is hiking rates right now, which in theory should be good for the large banks, you're starting to see these larger macroeconomic concerns about inflation perhaps popping that bubble, which is why you're seeing the reliance on this quarter on, again, trading instead of the actual bread and butter businesses of lending and then taking deposits. And I think that when you take a look at this situation that we find ourselves in, there could very much be a situation where even though loan pipelines have gotten bigger and better over the last year and a half or so, if people aren't able to pay back their loans because inflation is squeezing their pocketbooks, that's very much going to be a bad situation, which is the reason why JPMorgan Chase and I expect the other banks that are set to report tomorrow will also be increasing their provision for credit losses, because there is that concern that, yes, people are going out and spending, that's driving the inflation, but that also comes with the risk of people not being able to pay back their credit card debt because of that increased spending.